GT Bank kicking off with results yesterday. Profit after tax coming in 15.9% stronger quarter on quarter. Profit after tax surging over 25% year to date for the 9 months through to September. Strong growth in net loans in the quarter, and that took its loan growth for the period up to 18.6%, really similar to what we're seeing across the banking sector.
Good morning, Samantha. Thanks for having me. Yes, GT Bank's result was, I would say, a superlative result compared to what we've seen from all the other banks. For other banks that we have seen so far, there's been a slight weakening in their bottom line compared with first half of 2011. However, for GT Bank, the reverse is the case. We've seen them post even stronger earnings in the third quarter. Turnover was up by about 16%, while PAT was up by 35%. We saw a very strong loan growth as well of about 18.5% compared to customer deposit growth of over 25%. We also saw an improvement in their non-performing loan from over 6% in the first half of 2011. That's come down to about 2.7% in Q3. So overall, GT Bank's result has remained very strong, and the bank continues to deliver to shareholders.
With the bank continuing to grow its loans above management's target, what is your outlook for the full year earnings? Also looking at the type of earnings we're likely to see from its divestment in subsidiaries.
Yes, I mean, at the moment, we can't fully tell what the impact of that divestment in terms of the Naira and Kobo would be on their results. But what the management has provided guidance is that they expect that none of those subsidiaries would bring any form of impairment to their bottom line. And as such, for our own forecast, we expect their ROE to remain very strong at year end. We're putting an ROE of about 23% for GT Bank, and that's around about where they are right now based on Q3 results. So we don't expect any impairment to their results. You also remember that they had audited their first half results as well, taking in all the whatever provisions or mark-to-market positions are required and just generally complying with the IFRS requirements. So generally, we are comfortable with their results, and we think that the guidance that has been provided will be met by year end.
One of the trends that we're seeing is the increased cost of funding and that impact on net interest margins. And as you say, that's a concern going forward for all the banks in quarter four. Of the other banks that have reported, is there any standout numbers that you'd like to point out? Of course, we've had Zenith, First Bank, GT Bank and Access Bank to date.
I mean, I think just like you rightly said, for all the banks, they are going to be affected by the increased cost. All of that is coming as a result of the aggressive monetary policy stance of CBN, which has seen yields generally rise across the yield curve. And I think all the banks are going to be affected. However, for the top large banks, the likes of GT Bank, Zenith Bank and First Bank, given their very high customer deposits and the fact that they also have access to cheap retail funds, I think that those top banks are better positioned to manage any form of increase in their interest cost.
Moving out of the banking sector, and of course you did allude to the increase in the MPR, taking a look at what we saw on the auction on Wednesday, yields really spiking there for the sovereign paper that the government sold, 3 and 5 year paper with yields sitting at 15%, and 10-year paper yields shot up to 18% from around 11%. What implications does this have for government in terms of the cost of borrowing going forward?
I think the implications are very clear. The cost of borrowing is going to rise. Part of what CBN is trying to do is to ensure that there is a positive real returns on investment across the yield curve. And I think based on where we stand right now, that has been achieved. We see a situation where the inflation rate is around 10.3% for September, whereas yields across the yield curve come from, on the short term, it's around 15% minimum for 91 days instruments and rises up to 18% for the 7-year instrument that was done yesterday. So absolutely, the cost of borrowing for government is going to rise. The budget was set at about 450 billion naira for 2012. I think with what we see right now and the fact that they intend to raise about 185 billion for Q4, certainly the cost of borrowing will rise for governments.
Is there a sense that the market is confident that government will be able to sustain repayments on this debt with yields continuing to rise?
There's absolutely no concern about that. The government will certainly be able to maintain the interest payments. The payments are going to be made in Naira anyway, so there's really no risk for investors in terms of federal government being able to meet the payments on their instruments.
Let's look at the Naira. Demand for dollars at the auction has fallen as a result of the hike in the MPR and the liquidity squeeze. Is this a good thing for the Naira? We've seen it appreciate, and so of course we've had that impact filter through to date. Can it be sustained?
Could you please take that again?
In terms of your outlook for the Naira, we've seen the demand for dollars at the weekly auctions falling by around a half, and this has supported the Naira, given the fact that demand for the greenback has, of course, slipped back. Do you see this appreciation in the currency being sustained?
I think in the short term, certainly the appreciation will be sustained. The whole essence of the aggressive monetary policy is actually to ensure that CBN provides the necessary defense to the Naira. And part of what they have done is to reduce the net open position of banks from 5% to 1%. They've also curtailed access from some players in terms of the oil industry. For those who do swaps with NNPC and PPMC, they've curtailed their access to official FX, asking them to source their FX from the WDAS, from interbank, I beg your pardon. Also, we have a situation where foreign companies have also been exempted from accessing the official exchange, foreign exchange market. So generally what CBN has done is to ensure that they block some of the leakages and kind of maintain a sizable demand for the Naira, and I think that's is already paying off, because immediately on 12th of October the exchange rate was revalued to 150, and even then CBN continues to even meet all of the demand that comes from the WDAS window. So absolutely on the WDAS window, the Naira has firmed up, and we expect that to remain so in the short term. However, on the interbank segment, the liquidity has dried up significantly, and so the rates there is quite higher compared with the WDAS window.